The committee will come to order. Let me welcome all those in attendance this morning, and particularly our very distinguished Chairman of the Federal Reserve Board, Alan Greenspan. Today, our purpose in meeting is for the semi-annual monetary policy report, which the Fed will be presenting today to the Congress. As we know, this is the second appearance here for Chairman Greenspan within a week's time, and I think we had a very interesting discussion and a newsworthy discussion last week, and we'll have the chance to elaborate on that some today. Since the Fed's last report in February, the economy has continued to grow, and the current expansion is now over 7.5 years. But I think it is fair to say that the growth has been quite slow, and inflation, especially after this morning's report, seems certain to accelerate this year for the fourth year in a row. I might just say that the June CPI number of 0.5% gives us an annual rate through 6 months of roughly 5.9% in CPI increase. So that's a fairly healthy inflationary factor, as one would measure it by the CPI, and we'll be interested in knowing what your thoughts are on that and where you see that going through the remainder of the year. The New York Times has just done an analysis that was published on Monday, which indicate that 16 states are either in or close to being in recessions at the present time. Obviously, that depends on the definition, the economic definition being used, but it's obvious that there are some serious economic soft spots across the country. Also, when you were here last week, our discussion made a reference to your earlier testimony here with others with respect to whether or not we're experiencing a credit crunch in the economy. That testimony of some 3.5 weeks ago, as you'll recall, your feeling was at that time that there was not evidence that you could see and that convinced you that there was a credit crunch taking place. And then your testimony last week, I think, presented some different information, that some new data was emerging that was indicating that bank credit contraction might well be taking place, and that monetary policy would have to be adjusted to offset that. And we had some discussion on that, and I think all the members of the committee will want to pursue that with you further today. Also, because the RTC is accelerating its rate of spending with respect to the savings and loan cleanup effort, there's a question, too, as to whether that rather substantial flow of money might be otherwise distorting normal patterns of financial flows. And so I don't know whether you will feel that that is something as well that, with respect to money supply generally, is something that has to be taken into account. Finally, I want to pose to you as well, and I know this will come up in the course of the discussion today, where we've been at the budget summit now for some weeks. It's not clear exactly when or if that process will yield a result. There's been plenty of public indication that pressure has been applied by people who think that the Fed should be lowering interest rates either to deal with this softness in the economy or in anticipation of a budget summit agreement. And so we would be interested in knowing as well your thoughts as to how the Fed might respond if there is a budget package, if there is a major deficit reduction agreement that's worked out, what might be both the market reactions to that and what policy adjustments might the Fed itself think are appropriate. So these will be issues that we'll want to discuss with you this morning, and we're very pleased that you're here. Let me just start down the table here. Senator Garn.
Thank you very much, Mr. Chairman. Last week, when Chairman Greenspan was before this committee to talk about financial modernization, the big news item came from his comments on the relationship between, on the one hand, financial health of the banking industry, and on the other hand, monetary policy and the condition of the overall economy. And aside from the understandable focus on the chairman's comments as they relate to near-term outlook for interest rates. What I'd like to do is emphasize the broader impact of what you said last week, Mr. Chairman. Broader impact is there is a fundamental relationship between the health of the nation's financial institutions and the health of the nation's economy. It is because I am concerned about this broader consequence of financial institution health when this committee recently held hearings on the possibility of a credit crunch. I said that I gave the benefit of the doubt to the expertise of the regulators when it comes to evaluating loan quality. It is because of the importance of financial institution health that I believe the committee should not ignore, as we did yesterday, a direct legislative request from the chairman of the Federal Reserve Board of Governors when he is concerned about the danger of fraud against financial institutions. It was close, 11 to 10, but nevertheless, we lost. Finally, it is because of the importance of financial institution health that I applaud the chairman of the committee for his efforts through exhaustive hearings to continue to lay the groundwork for responsible legislative restructuring. With that, Mr. Chairman, I look forward to your testimony.
Very good. Senator Sasser, Chairman of the Budget Committee, Budget Summiteer.
Yeah, well, I'm surviving is about all I can say, Mr. Chairman. I'm pleased to see Dr. Greenspan, the Chairman of the Federal Reserve Board, here this morning, and I want to welcome you, Dr. Greenspan, before the committee. We always benefit from your economic wisdom, and I'm confident that that will be the case today. Dr. Greenspan, I want to commend you for the Fed going through a bit of easing just this past week. You stated, I believe, when you appeared before the committee just a few days ago, something contrary to what the banking regulators had told the committee 1 month before. They were saying that there was no credit crunch, and the Fed, as I understand it, took the position that banks were tightening their lending standards and that the markets were tightening independently of the Fed's action, and you took the action of easing somewhat, and I want to commend you for that, commend the Fed for it. And as you know, traditionally I've been one that's urged the Federal Reserve to ease on interest rates, but there are some things that cause me some concern, and perhaps we can pursue those a little further this morning, Mr. Chairman, when we get to the question period. But I am concerned. The Japanese interest rates are now getting to the point where they're comparable with interest rates here in the United States. And we find that West German long-term interest rates now are similar to the 8.45% Treasury bond rate here. So we're still in the posture of borrowing a substantial amount of funds from abroad to finance our deficit. So when we get to my turn to question, I'll be interested in hearing from Chairman Greenspan as to just how the problem of foreign interest rates, particularly Japanese and West German interest rates, interact with his ability to ease rates here in the United States, and how that might impact on or how the summit budget negotiations might give him a little more leeway there if we could reduce the necessity for federal borrowing from foreign capital markets. Thank you, Mr. Chairman.
Thank you, Senator Sasser. Senator Hines.
Mr. Chairman, I want to join you and the other members of the committee in welcoming Alan Greenspan back to our committee for the second report on monetary policy in 1990. Alan, I believe this is the third time you've testified before this committee in 4 weeks, most recently on Wednesday, when there was, in response to something that you said, a rush to the exit, a littered room of broken chairs. But I just want you to know that the fact that you have been here 3 times in 4 weeks means that we're going to invite you back and back and back until you get it right. quite seriously, Mr. Chairman, there are a number of things we need to look at today. One of those is the question of our economic expansion. It does continue, not as strongly as before. It is setting each month a new record. But the question is in part whether or not that expansion will be slowed or even curtailed by the credit crunch that Chairman Greenspan referred to last Wednesday. I think we need to examine with him what the uncertainty over the budget summit may be exacting on our economy, just as much as we need to examine what a $50 billion budget package of spending reductions and or revenue enhancements might mean to decelerating the economy. And most important of all, what happens, speaking of people getting it right, if people don't get it at all in the next several months and the budget summit drags on into October, November, and December? What are the consequences of that for us all? And finally, I want to, at the appropriate time, to raise the question that Senator Garn and others have referred to about the various kinds of other risks in our system, whether it is the one to banks because of what might be the inability of some banks not to be able to check up on the issuers of checks, the recent Price Waterhouse study of the Federal Housing Administration insurance program, which is not in very good shape, Bill Seidman's and the FDIC's recent revelation that they are at an all-time low in terms of coverage of their insurance fund relative to assets, the other kinds of failings that we've seen. There was a news article on a student loan investment scheme which people thought was federally insured. The question, in other words, is, are there some systemic problems that we in this committee and you as in effect our central banker, even though the Fed is not a central banking system per se, need to be taking a more comprehensive and thoughtful look at, so that we don't go through the kind of trauma that we've been going through with respect to the moral hazards and risks associated with the S&L crisis. Mr. Chairman, as I say, I welcome Senator Greenspan, Chairman Greenspan back to the Senate, and who knows how many more times we'll have to call him back.
Thank you. Senator Sarbanes.
Thank you very much, Mr. Chairman. Chairman Greenspan, I join my colleagues in welcoming you here this morning. I'd be interested in the course of your testimony, and if you don't cover it there, subsequently in the question period, to get some reading from you of what you think the risks are of a downturn or indeed a recession, and if it were to occur, how severe and extended you would expect it to be. Secondly, I note that in your statement you do, in your testimony, you do discuss at some length the credit crunch issue. It wasn't very long ago, less than a month, you testified before this committee on the credit crunch, and at that time you indicated, and I quote, "To date, we have found that lenders have tightened their standards in certain sectors and locales, but there has not, so far at least, been a broad-based squeeze on credit, and lenders are generally not retreating from lending opportunities." Now, that was on the 21st of June. Now, just last week, in testimony before this committee, and now in your submitted testimony this morning, you've apparently shifted your view on this issue. In fact, your testimony states, and I quote, "The weakness in the monetary aggregates in part signals a change in the behavior of depository institutions with potential for affecting overall credit provision. And you go on to state, it is difficult to discern the dividing line between lending standards that are still healthy and those that are so restrictive as to be inconsistent with a borrower's status and the best interests of the lender in the long run. In recent weeks, however, we have slipped over that line. And you go on to point out that the change in credit standards has its roots in part in the excesses of the 1980s, stating the weaker credits extended during that decade have come home to roost, and in so doing have impinged to varying degrees on the current availability. Now, this is an issue which has been of concern to members of this committee, and in fact, we were inquiring about and sending warning signals about a credit crunch for some period of time, even prior to the June 21st testimony. And I'd be interested in whether something dramatic occurred between June 21st and last week and then today to cause this shift in your view, or whether there was a trend going on, developments going on that weren't fully perceived but were perhaps even sensed by members of this committee, responding, as it were, of course, to anecdotal statements about a credit crunch which constituents were experiencing. I hope to explore that with you in the question period. Thank you very much, Mr.
Thank you, Senator Sarbanes. Another budget cemetery, Senator Graham.
Thank you, Mr. Chairman. Chairman Greenspan, let me try to sort of flesh out the question that I know everybody today would like you to answer, because we would like to jumpstart the summit, which responding to some law of political behavior set out, I'm sure, long before American government came into existence, which is the greater the crisis, the more likely politicians are up to some point to sit down and do nothing. Since the sequester order came out, I have seen no movement on the summit whatsoever, a lot of grunts and moans, but no action. And I'd just like to get you at some point, if you will, to give your response as to how you believe you could change monetary policy if the fiscal policy of the nation were changed as follows. If we had a real deficit reduction package in terms of permanent policy changes of a minimum of a $50 billion reduction in the deficit this year, if by changes in permanent law enacted this year we reduce the deficit over the next 5 years by the actions taken this year alone by a minimum of $450 billion, possibly as much as $500 billion. Graham-Rudman is set to expire October the 1st of 1992. If we extended Graham-Rudman a minimum of 3 years with ironclad enforcement of this agreement, including potential of the President having limited rescission powers if spending went above the cap set out in the bill. I'd be interested in knowing what you believe that change in fiscal policy would do in terms of your capacity to ease monetary policy in light of that overall change. The second question that I have, and a thing that I've been more and more concerned about, is the nature of the transaction that is occurring in the savings and loan industry. Now, I know it's good politics in Congress to talk about all this wealth transfer, but in reality we have a transaction that is fairly unusual in terms of financial transaction, and that is we are going out and borrowing tens of billions of dollars. We are then using that money to make deposits good that the deposit holder never felt were in jeopardy. So our transaction action basically is Aunt Sarah in Tyler had $25,000, her nest egg, in the local savings and loan. That savings and loan went broke, but Aunt Sarah was never worried because she had confidence in the federal government and its insurance fund. So she never changed her behavior. And what happens is we go out and borrow money, and then we use that money to fill the hole that exists in the reserves of the financial structure. Aunt Sarah's deposit is good. She doesn't change her behavior because she never thought it was bad. And so I am concerned about what we're doing to the overall financial structure of the country when we're borrowing capital, at least temporarily preempting it from other uses. We're using it to fill a hole in reserves, and we're not changing behavior on the other end. And those are the two concerns I'd like to raise, and I hope at some point in your comments you can address them. Thank you, Mr. Chairman.
Thank you. Senator Sanford.
I have got to go preside, and Mr. Byrd is in the chair, so I can't be late. I do want to comment that that's the most fascinating question I've ever heard, with all of those assumptions. I think the question is, if we continue to, as this budget agreement apparently will do, if we continue over the next 5 years to add close to another $1 trillion to the debt, if you'd work that into your answer too, and what would that do to monetary policy, I think that would be very helpful to us. And I'm sorry, Mr. Chairman, that time's run out on me.
Thank you, Senator Sanford. Senator Bond.
Thank you, Mr. Chairman. I want to keep my comments short because I usually find the answers much more interesting than our comments here.
Mine was fascinating.
Absolutely.
Well, I tell you what, once in a while you get lucky, Phil, and after all the comments you made, something's bound to be fascinating. But I find the chairman's comments generally much more interesting. But I would say that I just happened to meet early again this morning the same economist who gave me the question that I asked you last week, and you answered. But we discussed something further today, and that's the fact that long-term interest rates don't seem to have gone down too much as a result. There has been some favorable impact in the stock market, and we discussed why it was that the Federal Reserve's new move hadn't really affected long-term interest rates. And I suggested that perhaps the fact that I see you have set out in your testimony today that we have for too long financed a deficit that we don't have enough savings to finance here by borrowing abroad. We have now our debt is held by the in the international market, and frankly, on the long-term interest rates, they're going to be set by the international markets, and unless and until we get serious about reducing the deficit and make fiscal policy coordinate with monetary policy, it doesn't matter what the Federal Reserve does in the long term, as long as our creditors in other countries see a lack of will to bring down the substantial budget deficit. We're not going to get a very significant reduction in long-term interest rates. And without those, the Federal Reserve has its hands tied. And I would suggest that in your statement, your prepared statement certainly reflects it, that unless we get serious and have a long-term budget agreement, that we also implement, that we cannot expect the Federal Reserve to be the whipping boy and the one to blame for high interest rates. We're going to have to get serious on the fiscal side, and then perhaps the long-term interest rates and other factors will enable the Fed and its monetary policy to bring interest rates down. I believe you touch on it. I would welcome any additional comments you have as you discuss that portion of your report. Thank you, Mr. Chairman.
Thank you, Senator Bond. Senator Shelby.
Chairman, I have a written statement that I'd ask that it be made part of the record, and then I'll just have one brief comment to the chairman. He'll probably touch on it anyway, either in his opening statement or by questions. But what's bothering me is bothering a lot of senators, Mr. Chairman, and that is, how are we going to finance this deficit and continuing debt service that we have? And we're looking at these numbers. We all know what's going on as so-called budget summit, but we hadn't gotten to the summit yet. I don't believe the White House or the Congress. And I just see us borrowing more and more money from overseas, as Senator Bond just alluded to, and what is that going to do to our monetary system? Last week, you know, in some testimony, you certainly sent a good signal, or it was interpreted as such, to the market, and they reacted accordingly on interest rates. I don't know what's going to happen there, but some of the banks seem to be confused at times by signals coming from the Fed or coming from the press interpreting your remarks. Maybe that's more accurate. I hope today that you will try to, I wouldn't say straighten out those banks or those remarks, but perhaps make a signal that we can all understand forthrightly. Thank you, Mr. Chairman.
Very good. Senator Lotto. Thank you, Mr. Chairman. As you know, Mr. Greenspan has been in the forefront over the years saying that the one great problem that we have to overcome, in addition to the deficit, is that of capital formation, that of savings. And he's been saying this for a long, long time now, even before his tenure as chairman of the Federal Reserve. And I'd like to maybe try to put him on the spot a little bit and ask him and suggest to him if in the course of his testimony or at some point in time he might suggest to us the avenues available to encourage that savings. And not just the IRA, if that's a way, but what can we do? What can Congress do? Should we try to bring about some incentives to bring about that kind of savings pool which is so desperately needed here in the United States? And secondly, in our quest for revenues to deal with the deficit, it seems to me that we've got to be rather careful because if we raise revenues in the wrong way, in the wrong manner, we can actually do damage to capital formation and really bring about the recession that so many people are concerned about. And one of the areas, and I admit, it may sound parochial, and there are parochial overtones to it, is the proposition put forth relative to a stock transfer tax. I believe that would be devastating, not only to Wall Street, but I think as it relates to the investor, as it relates to capital formation, as it relates to driving the marketplace from the shores of this country. We talk about the ability of markets to move today. Not only can they move across state boundaries, and so while there is obviously a concern as it relates to New York, I think there's a much bigger concern that we should have as it relates to what problems could that possibly create, and I'd ask the chairman if he might speak to that issue as well.
Chairman Greenspan, we'll make your full statement a part of the record. This is a very important report in and of itself, and particularly at this time. So we'd be pleased now to hear your comments about it.
Thank you, Mr. Chairman. If the chair doesn't mind, I would like to read the whole statement into the record. I think it's important that I try to, because it is in response to a number of the questions which the committee has raised.
May I ask you, would you pull the mic a little closer so those in the back of the room can hear a little better? Thank you.
As usual, Mr. Chairman, I am pleased to be here today and in this connection to testify on our semi-annual monetary policy report to the Congress. In my prepared remarks this morning, I shall discuss, as is customary on such occasions, current and prospective economic conditions and the Federal Reserve's objectives for money and credit growth over the period ahead. Two areas of particular note at present with potential implications for the conduct of monetary policy are the ongoing restructuring of credit flows in the United States economy and the prospects for a significant cut in the federal budget deficit. I shall pay special attention to these topics in my statement. When I came before this committee in February, I characterized the economy as poised for continued moderate expansion in 1990, and in large measure, developments so far this year appear to have borne that statement out. Real GNP grew at a 2% annual rate in the first quarter, and indicators of economic activity for the second quarter suggest a further rise, though perhaps at a somewhat slower rate. Within this whole, however, the various sectors have moved along at fairly different paces. On the distinctly positive side, exports have shown solid gains, buoyed by expanding markets abroad. The impetus from international trade has been important in the pickup in industrial production this year. In contrast, the news coming from the household sector in recent months has had a softer cast to it. Consumers appear to have pulled back a bit as the slower overall pace of expansion and the more pronounced weakness in certain parts of the country, especially the Northeast, seem to have taken some toll on confidence in the economic outlook. Moreover, having accumulated large stocks of automobiles and other consumer durables earlier in the expansion, consumers could be more selective about when to purchase replacements. Sales of new homes have also weakened, deterring building activity. There are other pluses and minuses as well in the economic picture by sector and by region. But on balance, the economy still appears to be growing, and the likelihood of a near-term recession seems low, in part because businesses have been working hard to keep their inventories in line with sales trends. Although output overall grew rather modestly over the first half, the unemployment rate remained at its lowest level in almost 20 years. Over the past year, as employment has decelerated, so too has the labor force, in part reflecting a surprising decline in labor force participation rates for young people. Some flattening in the aggregate participation rate would be consistent with evidence that many individuals now perceive job opportunities as less abundant. Differences from past cyclical experiences, however, suggest that other factors also must be at work, if in fact the current pattern represents something more than noise in the data. This development certainly bears watching, for it may have implications for potential output growth. Be that as it may, with hiring proceeding at a less rapid pace, the rate of increase in wages appears to have leveled out from its earlier upward trend. The core rate of inflation in consumer prices, proxied by abstracting from movements in food and energy prices, picked up sharply in the first quarter, but has moderated in recent months. This moderation has been concentrated in the prices of goods, perhaps reflecting the ebbing of capacity pressures in a number of industries, while service price inflation has shown little signs of abating. While the figures that were released today, Mr. Chairman, were higher than one would like to see, it doesn't, in my judgment, really fundamentally affect the underlying trends. In fact, 2/10 of the 5/10 increase results from a sharp increase in owner's rental equivalent, which is a technical price evaluation of the cost of owning a home. And with gasoline prices presumably flattening out this month, and I would also presume that that technical home, the owner's rental equivalent will also slip back, I would be surprised if we did not get some slippage in the rate of increase in the CPI a month from today, reported for the month of July. In 1990, Federal Reserve policy has continued to be directed at sustaining the economic expansion while making progress toward price stability. Ultimately, the two go hand in hand. A stable price level sets the stage for the economy to operate at its peak efficiency, while high inflation inevitably sows the seeds of recession and wrenching readjustment. In the short run, however, the risks of inflation on the one hand and of an economic downturn on the other must be weighed in the policy-making process. The Federal Reserve saw those risks about evenly balanced over the first half of the year and made no adjustments in monetary policy. Throughout this period, which has been marked by dramatic changes in the flow of funds through depository institutions, the Federal Reserve has been paying particularly close attention to conditions in credit markets. Evidence of a tightening of terms and reduced availability of credit has gradually accumulated to the point where it became apparent in recent days that some action by the monetary authority was warranted. A number of indicators have been pointing in this direction, including the behavior of the monetary aggregates. Growth in M2, for example, which stalled out in the spring, has failed to strengthen materially, suggesting that the degree of financial restraint in train might be greater than anticipated or than appropriate to the evolving economic situation. This restraint is a function of developments in the credit markets independent of monetary policy. The recent decline in the federal funds rate to 8% as a consequence of our action to reduce slightly the pressures in the reserve markets represents an effort to offset the effects of greater stringency in credit markets. Other market interest rates generally rose early in 1990 as it became apparent that the economy was not as weak as many had thought. Long-term yields were most affected, increasing a full percentage point by early May. Subsequently, however, signs of a softening of activity prompted a reversal of much of that run-up. Rates on long-term securities remain about a half a percentage point above their year-end levels, but money market quotes are now little changed on balance. Throughout this period, rates on Treasury bills have remained somewhat higher than usual relative to those on private instruments, probably in part reflecting the large amount of bill issuance necessary to fund working capital for the RTC. The run-up in market interest rates early in the year was one factor behind the sharp slowing in money growth over the first half of 1990. M2, which had been running close to the top of its target range in February, posted no net increase between March and June. The weakness which moved the aggregate close to the bottom of its range was too abrupt to be accounted for fully by the rise in market rates, however. Another of the factors at work was the restructuring of financial flows. One aspect of this restructuring was the closing of insolvent thrifts by the RTC and sale of their deposit bases. Although the RTC's activities do not directly affect M2, the availability of huge blocks of deposits to the remaining thrifts and banks lessened their need to raise rates to draw in funds. In combination with the more cautious attitude depositories have exhibited towards expanding their balance sheets, the deposit transfers contributed to an unusual degree of inertia in the pricing of retail deposits. Households responding to the relatively low returns on deposits by looking elsewhere, as suggested by heavy flows into stock and bond mutual funds, and sizable non-competitive tenders at Treasury auctions. Nevertheless, while the movements in yield spreads can account for a good share of the slump in M2 growth, a portion of it still requires explanation. The cause of the meager growth this year in the broader monetary aggregate M3 is clearer. The RTC closed down a very large number of S&Ls, taking many of those institutions' assets onto the government's balance sheet and thereby effectively reducing the overall funding needs of the depository system. In addition, increased loan losses and the phasing in of tighter capital requirements circumscribed the expansion of credit at many other thrifts and banks. With depository credit growth limited, M3, which contains much of the associated funding, essentially stalled. By June, M3 growth was well below the 2.5% lower bound of the target range the FOMC had set in February. That range had itself been reduced a full percentage point from the target provisionally set last July in recognition of the potential effects of the ongoing contraction of the thrift industry. Lacking historical experience with a financial restructuring like the current one, however, it was unclear exactly how the flows would end up being redirected through the financial system, and in particular, how much of the thrift lending would be picked up by commercial banks. While the economy more broadly is about where we expected it to be, the configuration of the financial system is somewhat different, leading to less M3 growth than had been anticipated. The weakness in the monetary aggregates in part signals a change in the behavior of depository institutions, with potential for affecting overall credit provision. The conservative pricing of retail and wholesale deposits represents one aspect of their efforts to widen profit margins. In light of concerns about their capital position, banks and thrifts also have reined in lending activity and imposed stiffer terms on loans. The change in credit supply conditions may have significant implications for borrowing, spending, and policy. I would not call this change technically a credit crunch, as those words connote a contraction of lending on a major scale, with many borrowers effectively shut out of credit markets regardless of their qualifications. We are not seeing symptoms of that kind of widespread classic crunch as in the past when deposit rate ceilings or usury ceilings limited the market's ability to adjust and forced cutoffs of credit. But I can well appreciate that my view on this topic may be perceived as a semantic nicety by a borrower who today is suddenly unable to get a loan on the terms formally available. To the borrower, it makes little difference why the lender is pulling back or how pervasive the change in credit conditions is. From a policymaker's perspective, however, it is essential to sort the issues out. This means discerning the breadth and depth of the shift in credit conditions, its causes, its effects, and the extent to which it may ultimately be a desirable development. Clearly, the verdict is not yet in on the current episode. In economics, we are seldom able to make a definitive diagnosis until well after the fact, but to do our job, we must hazard some answers. First, what do we observe? The evidence on this score continues to grow. Numerous reports indicate that depository institutions and other lenders have become more selective in extending credit. In addition, Federal Reserve surveys of large banks support this sense that terms have been tightened in particular parts of the country and on certain types of loans. Especially hard hit have been financings for mergers and LBOs, commercial real estate, and construction and development. There also is evidence that small and medium-sized companies, as well as the poorer quality credits among the larger firms, have faced some tightening of credit availability. The change in credit conditions has taken various forms, including tougher standards for credit approval, higher collateral requirements, increases in interest rates, and in some cases, loans have been simply unavailable. Even investment-grade corporations appear to be facing slightly higher costs in accessing bank credit facilities. At the same time, a huge widening of spreads on less than investment-grade bonds has effectively shut down that market to most new issues. But on a number of other types of credit, changes in price and non-price terms appear to have been relatively minor. For example, the rates on residential mortgages, consumer loans, and the debt of investment-grade corporations have remained about in their usual alignment with other market interest rates. Because these credits may trade on securities markets and thereby access a broad range of investors, the interests of banks and thrifts in holding the obligations in portfolio has little, if any, effect on the cost to borrowers. These obligations account for a major share of the credit extended in the economy and hence the slowing of depository credit and the sluggish behavior of the monetary aggregates, while indicative of some tightening of credit, likely overstate the impact of the depository's behavior on economic activity. No doubt a sizable portion of lenders' increased reluctance to commit funds to certain purposes reflects a natural and healthy reaction to a slowdown in growth as the economy moves closer to capacity restraints. Prospects for continued strong production and sales increases fade, and the odds rise that some borrowers will prove unable to meet their obligations. In other words, part of the ongoing shift in credit conditions is what amounts to a regular cyclical event. But there is more to it than that. Through one avenue or another, the change in credit standards has its roots in part in the excesses of the 1980s. The weaker credits extended through that decade have come home to roost, and in so doing have impinged to varying degrees on the current availability of credit. Perhaps the clearest example is the real estate sector and its principal lender, the thrift industry. Those S&Ls that were the freest with their funds exist no longer, having been closed by the RTC, and the remaining S&Ls face tighter regulations constraining their lending. The resulting void has been filled quite effectively for home mortgage borrowers with highly developed secondary markets drawing funds in from elsewhere. For these borrowers, the shrinkage of the thrift industry does not represent a significant decline in intermediation services, but many other clients of thrifts whose debt is less easily securitized have been hard-pressed to find alternative sources of funds. Moreover, lax lending standards by both thrifts and banks contributed to overbuilding in commercial real estate, which has added to problems for lenders in this industry. Rising capital requirements for banks and thrifts have interacted with large losses on soured loans and the financial market's distaste for providing additional capital to the institutions taking these losses. This interaction has resulted in strong incentives for depository institutions to conserve capital. Their efforts to build larger capital cushions in turn have been manifest in a somewhat more cautious approach to lending, as well as a stepped-up effort to sell off assets by, for example, securitized loans. Partly as a result of tighter credit conditions, the growth of credit as measured by the change in the debt of domestic non-financial sectors has come down into closer alignment with the expansion of nominal GNP. This process, which reflects a somewhat more cautious approach on the part of borrowers as well, is not an aberrant, restrictive phase in the life of the financial system, but rather a return to what had been the norm prior to the 1980s. To be sure, when you go from excess credit creation to normal, it can feel like a tightening. And in that sense, credit conditions have tightened. Many of the loans made during the 1980s should not, by historical standards of creditworthiness, have been made. As standards reverted closer to normal, those weaker borrowers have been finding it far more difficult to access credit. In addition, however, depository institutions appear more recently to be lending with greater caution in general. As a result, even creditworthy borrowers may have to look harder for a loan, put up more collateral, or pay a somewhat higher spread. For the nation as a whole, the tightening of credit standards will leave the financial system on a sounder footing and contribute to economic stability in the long run. Nevertheless, in the here and now, the tightening is beginning to have very real, unwelcome effects. Diminished credit availability can constrain firm spending, for example, limiting more of them to internally generated funds. It is difficult to discern the dividing line between lending standards that are still healthy and those that are so restrictive as to be inconsistent with the borrower status and the best interests of the lender in the long run. In recent weeks, however, in my judgment, we may have slipped over that line. Such developments can and do occur independently of central bank actions and can have important influences on spending and output. Thus, the Federal Reserve must remain alert to the possibility that an adjustment to its posture in reserve markets might be needed to maintain stable overall financial conditions. As best we can judge, the change in credit conditions currently is exerting a slight additional degree of restraint on the economy. The process of credit restraint may not have reached completion, and some of its effects may not yet have been felt. Hence, it will require continued scrutiny. However, the tightening should eventually unwind as displaced borrowers find alternate sources of funds and as the banking system rebuilds its capital. This restraint has implications for monetary policy at present, and the ongoing restructuring of the financial system has implications for the conduct of policy over the foreseeable future. It is clear that the financial restructuring will affect the channels through which policy actions are transmitted ultimately to economic growth and inflation. Some will be diminished and others augmented. In these circumstances, the Federal Reserve has emphasized a flexible approach to policy making, which includes attention to a wide range of economic and financial indicators. At its meeting earlier this month, the Federal Open Market Committee reaffirmed the 1990 range of 3 to 7% it had set for the growth of M2. With the thrift industry likely to continue to shrink at a good clip and commercial banks expanding more circumspectly, depository institutions are not expected to be bidding aggressively for funds. As a result, although banks may replace more of their managed liabilities with retail deposits, M2 could well remain in the lower half of its target range through year-end. In view of changing credit flows, a slow rate of expansion in M2 seems consistent with continued moderate growth in output, but any pronounced weakness in the aggregate that drops it below its current range might represent greater monetary restraint than is desirable this year. Looking ahead to 1991, the committee lowered the M2 range by 0.5 percentage point on a provisional basis. We believe that this range is consistent with the continuation of measured restraint on aggregate demand, a necessity in the containment and ultimate elimination of inflation. Such restraint need not be a barrier to sustained growth. Indeed, it is a crucial requirement. As I suggested earlier, one thing that surely would jeopardize the current expansion would be for inflation to move upward rather than downward from the recent plateau. FOMC members and other Reserve Bank presidents generally foresee the policy embodied in the money ranges as leading to both sustained growth and diminished inflation in the period ahead. For 1990, their expectations center on an inflation rate in the 4.5% to 5% range, with real GNP growth of about 1.5% to 2%. With this year's slow growth helping to relieve pressures on resources, expectations for 1991 incorporate both somewhat lower inflation and somewhat higher real growth at a rate closer to that of growth in potential output. The path of M3 consistent with these projections has been heavily affected by changes in financial intermediation in recent quarters. Taking into account the current lending posture of the commercial banks and remaining thrifts, we now expect the closures of insolvent thrifts to show through in very subdued growth in M3. Accordingly, the FOMC voted to lower the 1990 range for growth of this aggregate to 1 to 5%. This action does not signal a tighter policy stance, but rather our recognition that financial markets have been adjusting to the RTC's activities in a somewhat different manner than we had anticipated, making the lower M3 target appropriate. In view of the considerable uncertainties about both the scale of RTC activities next year and the speed with which the banking industry will approach a more comfortable capital position, The new 1990 range was carried forward unchanged into 1991 on a tentative basis. Overall debt growth during the rest of this year is expected to remain around the midpoint of its reaffirmed 5 to 9% monitoring range. The non-federal sectors now appear to be increasing their debt about in line with nominal income growth, with the rapid pace of mortgage borrowing in recent years slowing into the single digits and corporate leveraging activity slackening. Growth of total debt in 1990 is likely to exceed that of nominal GNP, however, as the federal government's borrowing to fund RTC activities is expected to boost the total by roughly 3/4 of a percentage point. In 1991, the FOMC has provisionally reduced the monitoring range for domestic non-financial sector growth to 4.5 to 8.5%. Debt growth in this range should be adequate to support continued economic expansion while avoiding the excessive leveraging that characterized much of the 1980s. A number of uncertainties come into play in the process of judging the outlook for the economy over the next year and a half. Of particular concern in the context of monetary policy are the likely extent and persistence of the tightening of credit terms, the prospective path of potential output growth, especially in view of the recent slowing in the labor force, and the outlook for fiscal policy. It is the last of these that is the focus of the remainder of my comments today. The determination displayed by the Congress and the administration in their efforts to come to an agreement on cutting the deficit has been enormously heartening to all who are concerned about the long-term health of the United States economy. As a nation, we have been saving too little and borrowing too much. Significant progress on the federal deficit would be an important step in rectifying this situation. As you know, I favor not only eliminating the deficit, but also ultimately bringing the government's accounts into surplus over time to compensate for the private sector's tendency to save relatively little. In the long run, the nation's savings and investment behavior is crucial in determining its productivity and hence its standard of living. Major, substantive, credible cuts in the budget deficit would present the Federal Reserve with a situation that would call for a careful reconsideration of its policy stance. What adjustment might be necessary and how it might be timed cannot be spelled out before the fact. The actions required will depend on the constellation of other influences in the economy, the nature and magnitude of the fiscal policy package, and the likely timing of its effects. I can only offer the assurance that the Federal Reserve will act, as it has in the past, to endeavor to keep the economy expansion on track. Concerns that the Federal Reserve would be able to offset undesirable macroeconomic effects of a budget pact are, I believe, largely unfounded. It is true that in general, monetary policy cannot be calibrated extremely finely in response to economic developments, as we are all subject to imperfect data and an imperfect understanding of the myriad economic interrelationships of the real world. However, some doubts seem to focus on whether the various lags involved permit monetary policy to catch up to a change in the fiscal stance. I am less concerned, Mr. Chairman, on this point. We can decide that a policy adjustment is appropriate and implement it fully all in the same morning if need be. And the effects of the change will show through to interest rates and financial asset prices almost immediately. Granted, the impact on economic growth and inflation will be spread out over several quarters, but this is true of changes in fiscal policy as well. In the final analysis, no one can guarantee that growth in the economy will proceed smoothly without a hitch on a quarter-to-quarter basis. Nevertheless, a major cut in the budget is unquestionably the right thing to do. Because the federal government has been borrowing too much for too long, it is well past time to reduce the government's draw on credit markets and to free up more resources for enhancing investment and production by the private sector. In this way, fiscal policy, by augmenting national savings, will be doing its part to promote maximum sustainable economic growth. With monetary policy similarly keeping sight of its long-term goal of price stability, the two together will have set a favorable backdrop for vibrant and enduring economic growth. Thank you very much, Mr. Chairman.
Thank you, Mr. Chairman. That is a very detailed statement, and I appreciate the fact that you've read the entire statement into the record. Let me start with a blunt question, and I'd like as frank an answer as you can give. You make it clear that we need to have a budget package and it needs to be substantial in terms of a deficit reduction, and everyone on this committee agrees with that as a goal. And you talk about some positive effects that will come from that, assuming that's achieved. I want to ask the opposite question. There's not much progress that's discernible yet. Should we not get a budget package? If there's a stalemate and we don't get one, what does that mean for your ability or the Fed's ability to maintain a stable and balanced monetary policy?
Well, I think the question answers itself, Mr. Chairman. It obviously makes it more difficult for us.
How much more difficult?
It depends on what is going on in the economy. It depends on basically what is going on in the budget itself and what the borrowing requirements.
Wouldn't it give a pretty serious jolt? In other words, haven't expectations now been raised, not just here, but around the world? If we were to have the budget summit come to a dead end, I would think that you'd have quite an effect in terms of monetary reaction and financial market reaction, or do you not agree with that?
Well, Mr. Chairman, that depends on whether the markets have discounted or altered their stance with the expectation that a significant budget action will be implemented by the United States. I still sense a very large element of skepticism in the markets. And were that not the case, I think we would have seen a fairly major action in the bond market already as this summit process began to evolve. I think there is a deep-seated skepticism which is incumbent upon us to dissipate, because I think it does us no good, and I can't say to you what I think will evolve with respect to monetary policy, with respect to the markets, because there are so many elements involved in answering that question that I'm not sure I could do adequate justice to it in a realistic manner.
Now, very good. Let me move to something that relates to that. When you were here last week, you indicated the need to adjust the money supply and Fed policy to try to offset this credit tightening that you've elaborated on today. Is that credit tightening, if it were not offset, is that sufficient by itself to nudge us over into a recession? Does it offer that kind of a threat? Obviously, you're going to try to offset it. You've already made a policy decision to do that. But how material a threat would that be to the economy, the health of the economy as a whole, if it isn't dealt with?
It's very difficult to say. In our judgment, looking at the economy as it has evolved over the last 6 months, we think that the economy of the United States, its growth, its inflation prospects, the levels of unemployment, etc., would all be best served at this stage in balance if the degree of credit tightening, or put it this way, the degree of credit availability in the economy from whatever source remained relatively stable. And in our judgment, a tightening is not an appropriate response, or put it this way, tightening is not something we would like to see happen. I can't tell you what the consequences are. It clearly does raise the risks of tilting us over. I don't know whether it would be adequate to do that, but it raises the risks more than we would like. And so as we view our actions, it is not an easing, it is basically an offset to independent market tightening.
All right. Now, when you do that, and you've explained it, I think, clearly last week and today, when you make that offsetting adjustment, is it your intention to try to hold interest rates where they are, or is it your intention to try to nudge interest rates down somewhat from where they are?
It's our intention to keep credit conditions about where they are.
Well, but I want to...
That's an important distinction.
Well, that's what I want to get clarified, because...
Maybe I can explain something which I think might help in this respect. There's a general view that we in the Federal Reserve fully control the state of credit conditions. And it's presumed that if we fix a federal funds rate, were we to do that, that would freeze the state of credit conditions in the short end of the money market. That is not, in fact, the case, because there are other forces which impinge upon the market, either pushing credit conditions to a tighter or an easier stance. And it is that which affects the economy, not necessarily what we do. So we are often required to move to counter market forces if we perceive that they are having undesirable effects.
Well, so the bottom line of that is that you're not really aiming here with this policy adjustment that you're in the process of making to move interest rates as such. You're making the policy adjustment to make sure that the credit availability in the aggregate is in the amount that you think we need to have. Is that right?
That is correct, Mr. Chairman.
I want to ask you one other question, and that's with respect to our reliance on international borrowing to the extent that we are. The sense that I've had as we've had these discussions over now some years is that our maneuvering room in terms of these kinds of discussions, monetary policy, fiscal policy combined in this country, are very directly connected with how the rest of the world views our financial situation and their willingness to continue to lend us money and the rates of interest at which they're willing to lend us money. If we were to veer off course very far here with what the international community viewed to be an unsound financial and economic condition and strategy, wouldn't that have the effect of driving up interest rates in the sense that the international community would want a higher rate of interest generally in order to lend us the large amounts that they do every day?
Certainly, if they perceive that our policies are becoming irresponsible, there is greater risk, and that risk is reflected in higher rates.
And if the Fed tried in some artificial way to drive down domestic interest rates that the rest of the world viewed as being irresponsible and unsound and unsustainable, might it not then in fact actually have the reverse effect and drive up interest rates because foreigners would not be willing to lend us money?
I think the effect would be to take what has been a very moderate growth in the money supply in recent years to a much sharper degree of acceleration as we endeavored to push interest rates down by flooding the market. Money supply would take off. Inflation would not be that far behind, and inflation premiums would rapidly embody themselves in interest rates, and we would be worse off.
Thank you. Senator Hines.
Mr. Chairman, I think you and the chairman got to the heart of one of the questions I wanted to ask, which is what happens if the budget summit ends up over the next 2 or 3 months in a period of procrastination and nothing happens? What the answer to that question was, it would make Alan Greenspan's job a lot tougher than it is, and I don't know anybody who volunteers on a daily basis, on this committee certainly, to have his particular burden of responsibilities.
I might say that is a minor issue. What concerns me obviously far more is what it does to the American economy.
Exactly. And the question is, could the uncertainty of postponing a resolution until this issue, and I say could advisedly, create such uncertainty that not only would it be difficult for the Fed to manage it, but it might tilt what is already a fragile economy into a recession?
Senator, I don't think any of us can look into the future and come up with a scenario which one has any confidence in. All I would say to you is that I don't think we should position ourselves to take the types of risks we would do if we don't resolve this problem.
And among the kinds of risks, I assume there are a variety of them. There's high inflation, high interest rates, recession. Are those some of the risks?
At the moment, the major risk is not a crisis risk as such. The basic problem with the federal deficit is that it has reduced domestic savings in this economy for a number of years and has had a corrosive, virtually invisible effect in undermining our net capital investment and productivity advances.
You make that point very clearly on page 14 of your statement, which I want to refer to specifically. And I think most of the members of the committee would agree with you that we have a very serious lack of savings in this country, and we all talked about that. I'd like to ask you to focus for a moment on the other side of the equation, namely investment. Now, I know that to an economist, S tends to equal I in the old simplistic macroeconomic models that we all got in school, in Economics 1. But you know that's not the case, because we know that if there are a lot of savings, there tends to be more investment. But by the same token, if there aren't adequate opportunities for people to earn good returns on their investment, if it's more attractive to invest abroad than in the United States, as lots of companies have been doing for a very long time, for 10 or 15 years, for a variety of reasons. If other countries create, either fairly or unfairly, rules of the game that give their economies an edge, and we don't, that depresses returns to investment in this country. If our tax system unfairly penalizes returns to equity investors, and I think you believe it does, obviously that has an impact. My question to you is, in a time period where clearly, particularly in the manufacturing sector, product life cycles are shorter, the requirements for investment, retooling, new investment are accelerating all the time in order to account for the rapidity of change and obsolescence. Is the United States lacking a sufficient return to new investment such that people think it's better to consume rather than to invest?
I think the evidence, Senator, certainly leans in that direction. And the major reason why I think we have to address the budget problem is not because there is a yawning crisis in front of us. In fact, since there may not be, it's all the more urgent that we attack the issue, because it's very easy to go from month to month and say nothing has happened, therefore we're all right, as the whole process of corrosive undermining of the savings and investment process continues over the long term, creating the type of problem, Senator, which you raise. And if there's
my question actually went beyond the budget deficit, because while that can lower the overall cost of capital in an economy, if the overall return to investment is higher someplace else, or relatively or differentially low in the United States, people will go someplace else, irrespective of whether their cost of capital is 3%, 6%, or 9%. You may get less overall, but they'll go where they can get the biggest return. And so my question really reached out beyond the budget issue, but I don't have time to pursue it. I do have...
Well, let me just say quickly, the reason I raised the budget issue is I think it is critical to the issue that you raise.
I don't disagree, but I was trying to get beyond it, and obviously time is not going to permit us to do that. I note on page 11 of your statement that you indicate that restraint, you're talking about restraint and how it's clear, and I quote, that the financial restructuring, which you discuss at length, will affect the channels through which policy actions are transmitted, ultimately to economic growth and inflation. Some will be diminished, others augmented. As we look back on the last 10 years, which you identified as a period of excessive credit growth, and we look at specific failures such as the S&L failure, and as we look at all the other areas where government is exposed, which total an estimated $6 trillion from existing deposit insurance programs, loan and pension guarantees, direct loans, implied government guarantees of debt issued by government-sponsored enterprises, and all the rest. Does it seem to you that Congress needs to do a better job of examining and understanding the weaknesses and indeed the failures, as well as the prospective problems in the current system, and to implement much more comprehensively, thoughtfully, and aggressively than before reforms necessary in other areas? I'm going beyond the S&L problem, to ensure the protection of the federal government from other types or even levels of financial risk?
Senator, I think we all have to increase our knowledge of that whole structure of risks, and hopefully we are rapidly moving in that direction. It's to address the types of problem that is implicit in your question that we evolved the statement that I delivered here last week with respect to how we view the philosophy of the thrust towards banking regulation and banking structure changes, specifically emphasizing the question of capital. In a sense, all of the problems that we perceive in one way or another are reflective of the fact that we probably have too low a set of capital cushions, so to speak, throughout the system.
Mr. Chairman, thank you. My time's expired.
Thank you, Senator Hines. Before yielding to Senator Sarbanes for his questioning period, Senator Graham, do you have a brief opening comment that you want to make?
Mr. Chairman, I appreciate the chairman appearing again with us today. I do not have an opening statement.
Very good. Senator Sarbanes.
Thank you, Mr. Chairman. Chairman Greenspan, I first want to ask about a statement on page 4 of your testimony. Throughout this period, rates on Treasury bills have remained somewhat higher than usual relative to those on private instruments, probably in part reflecting the large amount of bill issuance necessary to fund working capital for the RTC. My question is, how much higher as a consequence of funding working capital for the RTC?
It's obviously significantly less than 100 basis points and maybe less than 50. I think my guess, without looking at the numbers, is 20 to 40 seems to be about. Yeah.
20 to 40 basis
points. My more thoughtful colleagues say a quarter of a point.
Now, I'm interested in the ranges for growth of monetary and credit aggregates which you've set out in the report. Are these ranges as wide as they've been in any report submitted by the Federal Reserve?
Yes.
4-point range?
Yes.
That's as wide as it's ever been?
I don't think we've been wider than that.
At what point does it become so wide that it's meaningless?
I would say much beyond 4 points it does.
I mean, we're at that point right now, in
yeah,
effect. I mean, are we now being given by the Fed a range that is so wide that it's really a meaningless exercise?
No, on the contrary. In fact, one of the issues that you raised in your opening remarks, Senator, with respect to the question of what has been happening in recent weeks is the fact that the money supply, which appeared in June to be coming out of what was a very sharply depressed May level and starting up and looked as though it was going to be back on track, stalled out again. And it stalled out in the context of the ranges which we have contemplated. And as I've indicated in my prepared testimony, we use those ranges as a meaningful measure of how we think the various aggregates ought to grow consistent with our view of the appropriate policy stance. So I'm saying to you that they are quite meaningful.
Well, suppose it was a 6-point range. Would that mean anything to lay out a 6-point range?
I think that you set a range in the context of where you believe a specific monetary aggregate is likely to fluctuate without significantly altering the thrust of one's policy stance. In my judgment, a 6-point range is unlikely to capture that.
In other words, if it fluctuates that much, it's outside the policy range. Is that right?
I would say it if it fluctuates that much and has no impact on the economy, one has to raise this serious question as to whether it is a useful monetary aggregate on which to focus policy.
Well, this is one item I want to keep an eye on. When the chairman asked you about interest rates and whether you were expecting to have a policy that would lower interest rates, you used a different phrase in response to that and made a point of it. Was that phrase credit availability? Or
credit conditions.
Credit conditions. And I take it that what you were saying by that is that you do not anticipate a monetary policy that would result in the lowering of interest rates.
I don't think we have a policy as distinct from the way I stipulated it in my prepared testimony. In other words, we don't have a policy which is other than contingent. In other words, we would do certain things under certain conditions, except as we meet at an FOMC meeting and sometimes make a very specific choice.
Well, you want to keep credit conditions as they are, as I understand it. Is that correct?
I would say in the current context, in the judgment of the committee, and to which I fully subscribe, stable credit market conditions at this stage would be appropriate for the best performance of the economy as we envisage it.
And I take it, since you made such a point of the distinction, that that would therefore encompass interest rates at about their current level.
I very purposefully discussed the distinction between short-term interest rates, the federal funds rate, and credit conditions. Most of the time, vast majority of the time, they're indistinguishable, but not all the time. And it is in this specific period that they have deviated sufficiently to induce an offsetting action on the part of the Federal Reserve, and that's the reason why we moved as we did on Friday.
Now, in your statement on page 3, you say, in the short run, however, the risks of inflation on the one hand and of an economic downturn on the other must be weighed in the policy-making process. The Federal Reserve saw those risks as about evenly balanced over the first half of the year and made no adjustments in monetary policy. I take it you're now making adjustments in monetary policy. Is that correct?
I think that's a semantic question. It depends on whether or not you are...
I mean, the question as to whether you're making adjustments in monetary policy?
The question as to how one, if you're defining policy in the narrow sense, obviously we have changed. If you're defining policy in a broader sense, meaning that we are endeavoring to maintain stable credit conditions, and the answer is we have not.
I see. So on the one hand, you've adjusted policy, and on the other hand, you've not adjusted policy.
Depends on the way you define it.
That's why Truman always wanted a one-handed economist.
I can understand.
Now, let me ask you...
Let me be very specific.
President Truman, he said he wanted a one-armed economist, so he didn't get these on the one hand and on the other hand the answers. Let me ask you this question.
I can give you three. I can give you.
I'm sorry.
Yeah, no, I think that it is...
I don't want to deny you your other hand.
The only thing I want to be, I don't want to leave unclear is that what we do is policy, but let's define exactly what it is we're doing it, why we are doing it, and that's a very important issue in understanding how the Federal Reserve interacts with the system.
Let me ask just one final question on that point, Mr. Chairman. I understand that.
If we can make it short.
You say the Federal Reserve saw those risks as about evenly balanced over the first half of the year. That was the risk of inflation, the risk of economic downturn. I take it you now see those risks differently. Is that correct?
I would say that we would probably say that the risks of a recession and inflation are about the same, but we have feel uncomfortable with that way of looking at it, if for no other reason than the surest way to get a recession going in this country is to allow inflation to take hold. In other words, I'm uncomfortable with that distinction if we fine-tune it too much.
Well, no, let me put the question to you. You've stated in your statement that you saw the risks as about evenly balanced over the first half of the year. How do you now see the risks? Evenly balanced? More so on the recession side? More so on the inflation side?
I would say at the moment they're still generally evenly balanced, though perhaps a shade more towards recession than they were earlier in the year.
Thank you, Mr. Chairman.
Senator Graham.
Thank you, Mr. Chairman.
Alan, you said...
If you'll suspend for a minute, I want to just describe for the home viewing audience the noise they hear in the background, and that is that whenever the chairman of the Fed is here and says something that some at the press table think is in the immediate news category, there's a burst of reporters out the door, and chairs are often tipped over. In fact, we now have in the budget of the Banking Committee a broken chair allowance that we have to factor in on those occasions when the chairman of the Federal Reserve is here, because so much importance is attached to the comments and the speed of getting those comments out. So that noise that often occurs in the background is the sudden exit of reporters who are running for telephones to inform the world as to what has been said. And I don't trespass on your time in saying that, but just so that people understand what the commotion is when they hear it on their television set and yet can't see it.
And a 60-point drop in the stock market.
Well, Mr. Chairman, I guess it simply shows the importance of a shade of difference. Whether the observer is capable of making a judgment about that shade of difference, we don't know, but at least they'll read about it tomorrow. Alan, let me ask you a question. I want to go back to your comment about how you believe the market has really discounted a major deficit reduction, the likelihood of a major deficit reduction action by Congress. I see that as good news for two reasons. One, it shows the market has not lost touch with reality, and that always encourages me. Secondly, I think it shows that the rewards are big. If with the economy getting a little softer, a shade of softening. If that were occurring with expectations already built up that we were about to dramatically reduce the deficit and change the fiscal policy of the nation, then I think the rewards of that action on the positive side would be relatively small, they having already been discounted. The reaction on the negative side, if we didn't do it, might be big. But I think the fact that the markets clearly have discounted any affirmative action substantially means that if we do something and it's dramatic, the reaction is likely to be large and positive. Do you agree with that?
If you mean on the budget as such?
Yeah.
I would say so. You know, let me say this in this context of, you know, what words mean all the time. I think it's important to define what the forces are out there. At this particular stage, as I've said in my testimony, I don't see any cumulative evidence that is working towards a recession. In fact, inventories are in reasonably good shape, and if credit tightening does not occur further in the markets, basically we should not expect to go off the track that we are currently on. And so when we are dealing with this issue of, you know, what's more important, inflation or recession, and what the balance is, I think that's too simple an approach to where policy is. And I think we have to keep in mind that we are endeavoring to keep the economy on an even keel as best we can.
Let me ask you a question about the SNL bailout, both working capital and the bailout cost itself. We are looking, obviously, we are now past the situation where a private entity is guaranteeing the payment of principal with a zero coupon treasury bond. That was the case we were in last year, and there was a legitimate debate about whether that should be on budget or off budget. I think we're past that point. I think clearly now the working capital, in my opinion, should not be on budget until we get an assessment of the loss, but once we've got the loss, that's an on budget loss. The question is, though, with the great uncertainties about it and with it actually with asset disposal in the out years potentially lowering the deficit as assets are sold, do you believe that the capital cost of the SNL bailout should be built into the Graham-Rudman targets or just isolated from it?
I would think they should be isolated.
I agree with you because I think, number one, they create a potential mischief in terms of manipulation, where you would borrow money at the end of one fiscal year and dispose of assets in another. And I think also by creating tremendous uncertainty, you create the potential that our ability to meet the targets is affected by the gods and not by us. Let's assume that we get a worst case scenario and we don't get an agreement and the sequester goes into effect on October the 1st, little over $100 billion. Current services spending is up 70, 75. So we're cutting $25 billion below the level we spent at last year. Bad public policy, across the board cuts make no sense. But at that point, if it really came down to a choice between suspending the sequester and in essence giving up on the Graham-Rudman process, or leaving it in effect at least until Congress did something, and if they didn't, leaving it in effect for the fiscal year, what would be your fiscal prescription?
That is an extremely tough question. I just would want to say that I hope that the Congress doesn't allow itself to get to that point. I think that the presumption of a $50 or $60 billion cut strikes me as the right order of magnitude for the first year, and I see no reason why proper policy cannot be implemented.
You know, we have a bad habit of the stock market collapsing in October. In 87, we had the 508 points, and then we had the budget summit agreement in effect in 88, such as it was. And then in 89, we had the 100-point drop. Are you concerned that if we get to October and we've got the sequesters triggered, we've got the uncertainty as to whether Congress is going to de-trigger it, whether they're going to take action, that we might have another slump in the stock market?
I used to answer that question as a private citizen, Senator. I would like to suggest to you that it would not be appropriate for me to address that question one way or the other. I mean, in all seriousness, I mean, there's no way I can know the answer to that question.
Well, I would think, though, Alan, that you would suspect that if, in fact, we had fiscal chaos in October, which we had in 87 and we had in 89, that would not be good for the equity market.
Fiscal chaos would not be good in September or November or December, October being whatever you
well, but October is where the law creates the chaos. But if you don't want to answer, that's fine. I don't
Senator,
know.
you know, there are so many hypothetical outcomes in here in which you can spin all various different types of scenarios, which I don't think really are all that useful. I think what we ought to do is focus on how do we get an agreement going, how do we get the budget deficit problem under control and get it behind us once and for all. I think the rewards of getting that budget problem behind us are extremely large. And while I understand the very difficult problems that the Congress is going through and the administration, I think the payoff is so large that it strikes me that we should not be trying to figure out what would happen under a variety of different conditions.
Thank you, Mr. Chairman.
Before yielding to Senator Shelby, I want to put an important fact in the record that we've just recently been given. You serve as a member of the RTC Oversight Board to try to figure out how to resolve the problems in the savings and loan industry. And I want to say, for Senator Graham's benefit before he leaves, we have just gotten a analysis from the RTC through the 12th of June of this year on the dollar value of all of the assets that have been taken back from failed thrifts. That's everything from golf courses to residential properties to land to what have you. And of all of the properties now in possession and, that have been taken in by the RTC and in effect been repossessed, 69% of the total asset value represents assets within the state of Texas, which is just sort of an interesting, I think, illustration of the fact that, well, it's a huge national problem when you sort of boil it down to where it is, at least in terms of that slice of the problem. What there is in the sort of on the junk pile, it gets different references. That fully 69% of the dollar value of the assets are found within a single state. I mean, that relates very importantly to the state chartered thrift problem, which is another story. And I don't
Chairman,
want to
could we at this point put the number on the screen that you call if you want to buy any of these assets?
Unfortunately, we've already bought them. We own them as the public, and now we need to try to sell them. But it's a very interesting fact. Let me just also say, Senator Kerry, you've joined us. Did you have any brief opening comment? If not, Senator Shelby. Senator Shelby.
Thank you, Mr. Chairman. I don't want to get into hypotheticals, Mr. Chairman, not too many anyway, but let's just suppose, knowing your background and knowing your knowledge of what the financial markets look forward to us in Washington to do, not to say. They discount what we say, but they really watch what we do. If, in fact, in the next several months, we make real, not imagined, deficit reduction here, that would be profound, would it not? Would be the right signal or a good signal to send to the Fed.
It certainly would, Senator.
would it be better for us to make multi-year outlooks in the deficit rather than just we're going to do a quick fix for this year?
No, I would say it's not better, it's essential.
It's essential. Having said that, so I would assume that any real reduction in interest rates in the market, real big, would be linked to the reduction in the deficit of what the Congress really does, not what it says.
That's correct, Senator.
Okay. Now, you mentioned earlier that of other forces other than the Fed. You know, the Fed, and you're the chairman of the Fed for many years, set our monetary policy, and we thought, so many people still do, I think that you as the chairman can just set it without regard to anything other than what goes on in the United States of America. Well, we know that's not true. But isn't it a fact that as we have become more and more dependent on our ability to borrow internationally from the Japanese and the Germans and the Swiss and others that will come forward, that they sort of have a leash on our economy in a sense? In other words, what happens in Europe, what happens in Frankfurt, what happens in Tokyo, is a leash on what you do at the Fed, just like a lot of domestic things that happen. Is that a fair statement? Is a leash too strong?
The leash is a little strong. I think it's
Is
clearly...
a rope?
Those are those are factors that we have to consider, and it does have affect what we do.
But it's a burden, is it? A sense, a burden that we...
It makes it more difficult, certainly.
Okay. So that ties in, does it not, Mr. Chairman, to our low savings rate. In other words, our savings pool has not grown as our appetite for money has grown. Is that a... And when you talk about here at the table, you've done this for years now for this committee, and you speaking for, as the chairman of the Fed, you're talking about a low interest rate and so forth in this country. It's just about essential to the future of our economy to up that savings rate in this country. Is it?
I think that's the most important domestic economic policy.
Number one, would that be your number one priority?
It would.
That and what would be your second, cutting the deficit?
Well, no, cutting the deficit
Or
is
would they
part
be
of that.
simultaneous?
No, cutting the deficit is a part of the strategy to enhance domestic savings in the United States.
How much, Mr. Chairman, of the domestic savings is the Fed eating up in the borrowing each year? In other words, the savings pool out there domestically in the U.S.
How much do we, the Fed?
Yeah. No, not the Fed, the government.
Oh, the government.
Oh, not you.
Oh.
I knew you didn't borrow, you create. Go ahead. In other words, roughly, what is the percentage of our domestic savings pool that is eaten up by the federal government's borrowing each year? And if you don't have that figure, if you can furnish it with the record.
I do have the figures
Okay.
here, but I'd like to submit them for the
Sure.
record because it's an important number which I want to make certain I get correct.
And as our borrowings internationally continued to go up almost vertically, or have they ebbed some? In other words, our
Well, the
appetite.
net borrowings abroad, which are best measured by a current account deficit, have come down a bit.
That's
but we're
good
still-
news.
It's good news, but if we can get the budget deficit down further, we're likely to also bring the current account deficit down in part with it.
Lastly, I want to get on something you mentioned, availability of credit, the tightening of credit. We had a hearing, and you were here several weeks ago. Secretary Kemp was here and others. And a lot of the builders in the country, especially in my area, the South and Alabama and so forth, they feel like they've been squeezed, you know, too much by the credit agencies, by their banks. Even if they have, if they've got good credit, they're solvent, they're doing well, especially in the area of home construction and land development. Do you see any easing of this, or has any of your studies showed this to be true? Or does it depend on region to region?
Depends on region, but there's no question there are problems in real estate pretty much across the country.
Is most of the overexpansion in real estate in commercial real estate?
Yes, very substantially so. There is fairly high vacancy rates in commercial real estate pretty much across the country. It differs region by region, but it's generally high pretty much everywhere, especially in office buildings.
Is that concentrated a lot in the East? I know it's everywhere, but a lot.
No, it's
everywhere.
I would say it's across the country.
Spread across.
There are differing problems in the East, but the issues are more severe in the East, obviously. But it's an issue which is, as far as vacancies are concerned, it's a nationwide phenomenon. That is not obviously true in residential to anywhere near the extent that it is.
You've got a different market there with a secondary market, haven't you?
Yes.
Mr. Chairman, my time's expired.
Thank you, Senator Shelby. Senator D'Amato.
Thank you, Mr. Chairman. Alan, February of this year, when you spoke about your favorite topic, or at least the area that you identified as one being in need of treatment, and that is savings. And at that time, we talked, and you said that you thought, and I'm reading, that the double taxation of dividends was an area where you picked it out as one of the structural problems, and that if we eliminated double taxation on dividends, that would enhance savings.
It would certainly improve the financial structure.
What other suggestions do you have for us as it relates to methodology to attempt to enhance savings? Understanding the importance of reducing the deficit, putting that aside, we all agree with that.
Senator, I think the first thing that we've got to be clear on is that when you reduce savings, when you increase savings, you have to reduce consumption. And any incentive, any tax incentive, any policy incentive always has to be looked in terms of, does it actually reduce consumption relative to income, or is it merely a transference of one savings vehicle to another? And in that regard, I would say that we are having great difficulty finding policies other than the issue of endeavoring to bring the budget deficit down to zero, and as I indicated in my prepared text, hopefully to surplus, in finding useful means which would increase savings in significant amounts. I mean, there are no question that there are small, marginal type of programs which probably help in minor ways, but the only thing that,
for example,
I think that exactly. I think
that would
the
be a marginal increase.
Yeah, the evidence there is mixed, and if there is net savings from IRAs, and there may be, it's relatively small.
So you'll do list, though, double taxation of dividends, the elimination of that as a positive step.
Oh, that is unquestionably desirable, yes.
Some form of IRA as a marginal improvement.
Yeah. Well, let me just say that it depends on the form of it. What I'm trying to say is that I have not come across a program or a policy to significantly increase savings in this country other than, at this stage, going towards a budget surplus. I wish it were otherwise. I do not like the notion of having to look to the government to supply savings to the private sector. But there is no question at this stage that we need that. We need the savings. And hence, rather than look for a variety of different gimmicks, which I've seen too many over the years, I would think it's far more important that we look to getting the budget deficit issue behind us, moving it towards surplus, and then looking for other means to augment the savings of the system at that time.
Let me touch on, I was going to do the no-no and talk about a broad-based energy tax as a way of reducing the deficit. What is your feeling in regard to that?
Senator, I realize that there are a lot of new items that will be going on the table in these budget negotiations. I would prefer that I not be requested to comment on any of these. I think it'll just muddy the waters, and I would prefer to stand aside.
So if I were to then propose to you what would be the most beneficial in terms of reducing the deficit, a hypothetical, if you had to choose your poison, would it be a stock transfer tax or would it be a broad-based energy tax? You would decline to answer. You would not like to answer.
I would just assume.
Which way you would choose your death?
I would just assume refrain at this stage, if you wouldn't mind.
All right. Do you believe, if you care to answer, that a stock transfer tax would be in the best interest of dealing with the problems?
I repeat, Senator, I just assume not to get involved at this stage.
And I respect that, but I have to say, for the record, that I honestly believe, Mr. Chairman and Chairman Greenspan, that the stock transfer tax would absolutely do total violence to the principle of attempting to bring about capital formation. That it would all but eliminate and push the small investor, who already today treats the market with great skepticism, and I believe, based upon program trading, this business of coming in to say that the SEC should regulate Chicago and the margins, maybe they should, maybe they shouldn't. But if they come in and regulate the margins and you don't have program trading under control, you're not going to do anything, and I'm afraid that Senator Graham's comments as it related to October coming and hitting one of these points in time when we have 100 or 200 or plus drop in the market is going to take place. It will absolutely take place. And we're talking about nothing but greed. And it's just greed that powers the Wall Street houses to undertake this. Again, I spoke to a number of the operators of the investment banking community. They all suspended, they all got out, and then when they saw their best friends back in making monies, how did they say to their management people, why X, Y, and Z firm are back in and we're not going to do it? And I think to date there's only one. I think it's Dean Witter's the only major firm that's not back in. Maybe I'll get a call from someone else who'll say, no, we're not back, and we're fine. But everybody else is back in there, and they're doing it at, I believe, the detriment of shareholders, the average shareholder. They're doing it to incur their own profit advantage for the trading houses themselves, and I think they're helping to destroy a great system, and it's going to ultimately, we're going to lose confidence in this, and then we're going to get the kind of over-regulation that we all abhor. I've gone past my time. I certainly recognize that the chairman is in a difficult position given the negotiations. I'd like to free him from that restraint. And
I thank you, Senator.
All right, thank you. Thank you.
Very good. Senator Graham.
Thank you, Mr. Chairman. Mr. Chairman, on one of the Sunday morning programs and reported extensively in Monday's press, the chairman of the Federal Deposit Insurance Corporation, Mr. Seidman, made some observations about the solidity of the commercial banking system. He commented that he felt that the insurance fund was adequate to handle a mild recession, but that if economic conditions should deteriorate beyond that, that he had some serious concerns. As I read those articles, I had a sense of recall of similar statements being made back in 1987 relative to the savings insurance fund. What is your assessment of the state of the insurance fund for commercial banks? And second, based on that assessment, what, if any, recommendations would you make for congressional action?
Well, Senator, I can't go beyond what Bill Seidman has said. He's obviously in charge of it. He is far more knowledgeable about the specific elements within his system which would change under various economic conditions, and clearly I respect his judgments on that. With response to the broader question, as I indicated here earlier and as I indicated here last week, the reason why I believe that we need more capital in our depository institutions is because I think that leaving aside the FDIC fund, rather all of the both FDIC funds, we may have to make certain that there is an adequate capital buffer in our depository institutions so that, in a sense, questions about the adequacy of the funds just don't arise. And the basic thrust of my remarks here last week to look to enhanced capital and prompt resolution were both directed at the issue of insulating the insurance funds.
So is the answer that you do not have any recommendations beyond those initiatives that are already in place for Congress relative to the security of FDIC?
I would assume if there are any recommendations, they will evolve in the context of the FIREA mandated study which the Treasury is involved with and which we at the Fed are acting in concert with them.
So, the reason I'm emphasizing this is because during the period of 87 and 88, we had a number of persons who represented various S&L regulatory agencies who came before the committee and when asked what should Congress do, essentially said nothing. We have the situation under control. We don't need any steps at this point. In fact, representatives of the Treasury almost said it would be unpatriotic if we were to do anything because that would create a false fear in the public when no such fear was justified. So I want to be clear that your recommendation at the present time is that no congressional action is called for pending the studies that are currently underway as to the deposit insurance system.
Well, remember, Senator, that FIREA mandates that the fund go to 1.25% of deposits from the 0.7 that it is today. I would hope that these studies will be forthcoming reasonably quickly, and to the extent that any actions are required or any suggestions are appropriate, that they would be made in an expeditious fashion.
And I would like to conclude this set of questions with this request. If there are any circumstances that come to your very advantaged perspective that would alter your sense of urgency and congressional action, that you would alert us to that change in position at the earliest moment.
We certainly should. We certainly will.
Senator Graham, would you yield at that point on my time because this is, I think, an extremely important issue, and I think Bill Seidman has given an important warning signal in his public comments. As I understand it, we now have about $12 billion left in the bank insurance fund, and it's protecting a total of about $2.5 trillion in total deposits. That's a tremendous, obviously you've got bank capital in the balance sheets, however one values that and so forth, but it is a very small balance in the bank insurance fund, and what I would like to have done here, I think in light of his expressed concern, I think a look needs to be taken at that now, and not just in the context of the FIREA mandated studies and other adjustments. I think we need to understand whether there are, particularly given the fact that we're seeing the softening in various areas of the country, softening in real estate values by areas, softening in stated bank balance sheet numbers and so forth. I think we have to assure ourselves that we don't have a problem there that we're not alert to. And so I would ask you and the Fed to take a fresh look at that now, if you would, not in any crisis sense, but I want to understand and have you be able to indicate to us if the Fed independently sees anything out there. You know, this could be analogous to what, you know, in the credit crunch hearings, there were things developing and that, you know, sometimes you can't see them until you can see them. You might think they're coming, but until you get data and so forth. I think in light of the concern that he's expressed publicly, I'd like a look taken at that.
Okay, we shall do so, Mr. Chairman.
Very good. I thank you for yielding.
A collateral question which caused me to read Mr. Seidman's remarks with special alarm is that economic conditions seem to be moving so rapidly and in many cases in a negative way. It was almost exactly 23 months ago that one of the most well-positioned persons in the country, the then Vice President of the United States, made the statement that his economic assessment of the future was such that he felt we could achieve our nation's economic and fiscal goals solely within spending reduction strategies. That position was reasserted 7 months ago in the State of the Union address. This week we've had a report from the President's budget advisors that if we were to follow that strategy, that very serious negative occurrences would be the result. What do you think has happened in the 23 months since August of 1988 and in the 7 months since January of 1990 that have caused the assessments of some of the most knowledgeable and best informed people in the federal government to now be so wildly out of touch with what current economic circumstances are?
Well, there are a lot of technical differences that have emerged with respect to estimating the budget deficit and specifically receipts. The effects of the Tax Reform Act of 1986 were not clearly evident until fairly recently. In other words, we were getting receipts data coming in under the new statutes, the nature of which was not sufficiently clear to the estimators, so that I think for a while there was a presumption that as an aftermath of the 1986 Reform Act, the ratio of tax receipts to taxable incomes was actually higher than it has ultimately turned out to be with respect to liabilities.
And that was not a circumstance that was foreseeable either in August of 1988 or January of 1990? I
think not. I think it may not. I don't know the answer to that, but my impression is a lot was learned in the April tax receipt period, specifically with respect to final settlements. That was certainly one element. There are clearly other elements involved. I mean, there were estimates of the rate of economic activity in nominal taxable income terms, which were higher than has turned out to be the case. Their interest rate assumptions turned out to be lower than turned out to be the case. And I think what we're seeing in this particular process is that when you try to estimate the difference between two totals, both of which are of the trillion-dollar order of magnitude, relatively small percentage changes have fairly significant impacts on the difference or the deficit that we calculate.
I guess if those types of circumstances in a relatively short period of time, 23 or 7 months, could have caused such an extreme difference in the end results.
Senator, excuse me once a minute. Let me introduce one additional issue which is relevant. The way in which the budget is forecast by the administration is to assume that the requests of the President are fully implemented by the Congress. And depending on what those requests are, you can get a very significant different budget forecast than from what we call baseline or used to call current services. And I think that the numbers we're looking at today are more baseline current services, whereas those that refer to the two cases in which you were referring were, I believe, administration forecast with policy implementation full, I believe.
Well, I could understand that to some degree starting in August of '88, but in January of 1990, making projections for the fiscal year that will begin October 1st, 1990, what deviations from the President...
1990, okay, fiscal 91.
I'm talking about the State of the Union address that was delivered in January of 1990 and the statements that were made about the economy that time, in contrast to the statements that were made Monday by Mr. Darman, Mr. Brady, and other representatives of the administration as to the state of the economy at that point. And I'm trying to understand how there could have been such a variation since the Congress has not taken action on the President's budget request in any definitive form for the fiscal year that will begin October 1st. I don't see how that could have been a factor in causing such a dramatic shift over the 7 months period.
I would have to look at the full details, which I have not as yet had a chance to look at, but I do think you can explain a very substantial part of that strictly by the issue of whether you consider the President's policies are fully implemented or not. There were unquestionably technical differences with respect to the economic forecast, which are relevant, but only partly so.
Well, Mr. Chairman, my concern, which as I indicated was elevated by the statements of Mr. Seidman, is we seem to be in a period of tremendous economic flux. If circumstances can change as dramatically in 7 months as they have, if the shifts can occur in just a matter of weeks, almost dated by your testimony before this committee, I think that it behooves us all to have a very highly elevated antenna in terms of observing these events that are occurring with increasing rapidity so that we can understand them and attempt to take actions that will be in the nation's benefit.
Thank you very much, Senator Graham. Senator Kerry.
Thank you, Mr. Chairman. Mr. Chairman, thank you, and appreciate the opportunity to visit with you yet again. I want to pick up, I had wanted to ask a number of questions. Some of them were asked by the senator from Florida, but I shared his concern about the comments on Face the Nation on Sunday and the reports thereafter. And I want to ask a number of questions about that, if I may, as well as a couple of others. I understand we have about $13.2 billion or so in the FDIC fund now, with $2 billion of losses expected this year, bringing it down to $11 billion, which means about 60 cents in the fund for every $100 of insured deposit, which is about half what the Congress intended and what people have determined is sound business. On the other side of the ledger, against that seemingly somewhat impoverished fund, is an increasing series of reports from various people around the country. Stanford economist, among others, Dan Brumbaugh, who is widely reputed to have been one of the early forecasters of the S&L crisis. He is now suggesting that we're at the point in which, in a short period of time, taxpayers are going to have to make a contribution to the closure of insolvent banks, that either we're going to have to contribute additional money to pick up the tab for these bank failures on the commercial side, and in addition, that there may be additional money needed simply through the premiums that banks are going to pay for insurance and so forth. Now, it has been asserted by some others, let me quote them, that once you subtract the expected losses from FDIC assets, the net reserves are probably around zero. And Mr. Brumbaugh himself says, I quote, "We are in the midst of reliving the S&L crisis in the commercial banks. The stage we are in is about the same as 1984 and 85 with the thrifts, when the problems of many savings and loan associations were far more serious than their financial reports revealed. We are moving down the same road as the thrifts," another economist said, "but the road is not so steep and we're not so far along." Can you comment on that? Because I think it has an enormous implication. You know, our citizens are not only angry, but they're now hearing these reports and they're scared. And that's having, I think, something of an effect on their use of money. Certainly retail is feeling that, I think, to a degree. But more importantly, some people are even questioning whether they ought to put their money into these, some banks, and how safe it's going to be down the road if this scenario plays out.
No, I think that report which you cited is an exaggeration, and I must tell you that I don't have those types of concerns. The types of concerns I have are more to make certain that we build up our competitive capabilities as a banking system, and that we improve the structure of the total financial system. But I would scarcely argue that we're in a position where the thing is about to unwind. I think that's just something which comes up periodically as an issue, and I think there's no real basis for it. I think that we do have to raise capital in our commercial banking system. I think we do have to be somewhat more prudential on lending relative to the types of lending that occurred in the mid and latter part of the 1980s. But those are readily resolvable issues in my judgment, and not something to create any really serious concern for anybody.
Now, if we are augmenting the amount of capital that these institutions are holding, while simultaneously dealing with the credit issues that you have talked about, therefore, as you have called it, I mean, you've suggested the semantical problems in your own articulation of the credit problem, and what some call a credit crunch is for you a shift in credit bases, but to the consumer it has the same effect. But if you have that coupled with the increased capitalization requirements for these institutions, coupled with the earlier comments in your testimony, which I read, concerning the diminishing labor force, plus the prospect that we are sitting on here of increasing taxes while simultaneously reducing spending, that seems like a monumental conglomerate of simultaneous drag on your economy that's going to have an enormous impact on your forecasting, I would think.
Senator, some of those things I think are quite healthy. And in fact, I believe that even though it has been quite painful to have the rate of increase in credit, not only the money supply elements that are sort of proxies for the overall credit, but I mean the broad credit expansion in mortgages, in corporate debt, in consumer credit, all of these things which were having in total a very large rate of expansion, especially with the mergers and acquisitions and LBOs. It is very important that that type of expansion come back to normal. But the process by which it occurs makes it feel as though it is harmful to the system, when the truth of the matter is it is not. And the difference between, I'll put it this way, it probably doesn't feel any different to the average potential borrower whether or not we are coming down from an abnormal level of expansion of credit back to normal, or whether we are going from normal to too restrictive. I mean, it's a continuum in the sense so far as he's concerned, but it matters very much to the overall system. And in my judgment, I feel somewhat, I would say, more secure about my view of the soundness of the system today than I would have, say, 2 or 3 years ago.
And is that because we're dealing with it?
Yep. Well, basically because the rate of credit expansion, which I found rather disturbing, has come down. And we are dealing with it. And I think that whatever one could say about concerns about the system, they have to be less now than they were, say, 3 years ago. Capital has actually increased. The rate of borrowing has come down. The credit standards, if anything, have improved. That strikes me as pluses, not negatives.
And unemployment is up, and...
No, unemployment is down.
Not in New England.
Well, I certainly grant you that unemployment is up in New England from a very low level, and you are experiencing the worst part of the problems that we are confronted with. But if you think of it in terms of the national figures, including New England, the unemployment rate is still at the lowest level in approximately 15 years.
Well, now, in the course of the current revision of the estimates of the deficit, now at $168 billion, and then the S&L on top of that, we're looking at an enormous contraction this year under Graham-Rudman, and it depends obviously on whether we start talking about moving the dates or what happens, and that's not on the table at this point in time. Looking at the kind of deficit reduction that we're now looking at, and recognizing the President has now said, I think we need taxes and we're going to need some revenue to do it. I know you don't want to deal in specifics, and I'm not asking you in specifics, but is there a range of revenue to reduce that deficit that begins to become excessive and, in your view, have a negative impact on the economy? What is the balance between cuts and revenue, in your view, that...
Senator, there are differences between revenue and taxes in the way one balances or brings the budget deficit down. The differences do affect the economy in certain different ways, because obviously different types of taxes, different type of program changes have different type of effects within the economy. But I would suspect that overall, it doesn't matter all that much. That is, it is the absolute total size of the deficit reduction that is crucial. And rather than worry about the effect of the composition on the economy, I think we ought to focus very clearly on getting something which I think in the area of $50 or $60 billion does strike me in today's context is the type of deficit reduction which could be implemented without undercutting the growth in the economy.
Mm-hmm. Now, if I can, I don't want to abuse the time too much here, but I'd like to just ask another question.
You're going to move on to the subject. I'd like you to just yield for a minute, because I'm not totally clear, and it may be that I just didn't hear it right, or there may have been a word left out here or there, but are you saying in a package of that size, 50 to 60 billion, that the exact component that might be new revenue versus spending cuts really isn't the key question in your mind? The key question is whether whatever the proportional shares, that it add up to that kind of a total package?
It's basically the total package, and whether it is credible, and whether it has subsequent wedge effects. In other words, as we have discussed earlier, it's the first year number is merely a proxy for a much broader program. But I would say it is the total program which is the crucial issue, and its composition is of a lower order of importance. I'm not saying that the composition has no effect. I've expressed before this committee many of my views on the balance of taxes versus spending, and I don't certainly retract those. But I think the crucial issue by far is the overall program. And I must say to you, Mr. Chairman, when you look at what we have got, I mean, including the types of problems that we have been discussing, the economy has been behaving much better than a lot of people feared. I mean, we have been confronted with scare stories now about what was going to happen to the economy for 2 or 3 years. I mean, ever since the 1987 stock market crash. And I think we must say, in looking back in retrospect, that things are not doing all that badly. I mean, as far as we are concerned, I think we are comfortable that we've been able to keep the money supply growth at a relatively low, stable pace, which in our judgment ultimately will pay off in a lower rate of inflation, which with greater stability. And I think in part because of the fact that inventories have gotten under control, we are not subject to this degree of instability that we have taken, that we are going through. I grant you that the rate of growth is slow, and whenever the rate of growth is slow, you're closer to the edge clearly than you are when the growth rate is higher. But the point at issue is that having said all of that, I think things are not too bad. And I must say I'm rather pleased with the way the system is working. I didn't like the fact that we've got a huge problem with respect to the resolution of the savings and loans. I mean, it does have a very material effect on how we do our business, but having gone through a period with a very rapid resolution in June, for example, without significant impact on interest rates or without a significant distortion in the system, I mean, I think we ought to be somewhat aware that this is suggestive of an economy which is not on the edge of either falling apart into a recession or about to take on highly inflationary characteristics. I think that we've done better than I think we probably could have forecast as a reasonable judgment after that 87 crash.
I appreciate your saying that. If you yield just for another minute, I want to nail down, try to, the point that I also thought I heard being made in response to your question, Senator Kerry, and that is, I hear you saying that if we can get a deficit reduction package that's in the $50 to $60 billion range, and that it's built in so you get the out year, the wedge effect in the future, that if that were split 50-50 as between revenues and spending cuts or somewhat more or somewhat less either way, that the macroeconomic effect of that, as you would see it, isn't all that big a deal. The big deal, as you see it, is to get the package with whatever the blend is between revenue and spending cuts, as long as it adds up to that kind of a total, and it's real and it goes into the out years. Is that right?
It's real and enforceable.
Well, that's a very important point, because you're in effect saying here that the macroeconomic effect of the package is really dependent upon having the package, and that if we end up fighting endlessly on the composition, on a little bit more of this or a little bit more of that, that we may well be missing the point.
Yeah, but let me say this. Obviously, I'm not talking at the extremes. I'm
No, I
talking
understand.
within
I'm not
a range,
posing the
because
question.
I mean, I will tell you, as I've said to this committee before, that if we were to do it all on the tax side, very
Yeah, no,
honestly,
I'm
I don't
not
think it would.
suggesting that.
I don't think it would ultimately function. But the answer is yes. Within a range, the differential macroeconomic impact cannot be large enough for us to be concerned with. This issue of resolving the budget deficit problem is so difficult that to add additional difficulties when they don't matter all that much strikes me as inappropriate.
Well, and it's an important, refreshing comment by you, and I think it helps the debate. Now, I realize this being said at 12:20 in the afternoon, and I don't know whether it'll make its way out of here the way I think it ought to, but I think the questions that Senator Kerry has posed and the answers that you've given are important, and I think they've put this debate in a somewhat new and clearer light, and I think it's helpful. Senator Kerry, why don't you finish up?
Thank you very much, Mr. Chairman. I thank you for drawing that out further. I had thought I had understood it as that, but I'm happy that you focused more on it, and I think it's helpful. Mr. Chairman, assuming we get the package, is it your view that the Fed should move to interpret the results of that package, or that the credit markets should do so on their own with the risk that they might bid the interest rates down too low or not enough?
I think that at the end of the day, it's the credit markets which count. And we obviously will be focusing very closely on how the markets respond and how the markets evaluate the package.
Now, beyond, well, let me hold off on those questions. I don't need to do those now. I do want to ask you this, though. I was struck in your testimony about the employment decelerated, but the labor force also, and you talk about some of the aspects of the labor force, and I wondered if you weren't underplaying the impact and the problem we face in this country of now having seen many, many women brought into the labor force, considerable minorities brought into the labor force, the birth rate being such that the bubble is over on the baby boom, and that we face a serious problem in terms of growth. I know that we're increasingly feeling this in New England, and I wonder if it is not underplayed somewhat in your testimony and in the importance for this country's ability to be able to, quote, get moving again and really see the kind of growth that we want. Do we have the capacity for growth in the labor force that will permit that at this point in time?
Well, Senator, we've had an odd slowing down in the labor force growth really since the beginning of the year. And it is reflective to a large extent in the participation rates in both males, mainly females aged 20 to 24, and in teenagers. But even the rate of growth in the participation of adult women, which had been such a major factor adding to our labor force, we've seen some slowing down. Now, it is quite possible that this is merely a statistical aberration. Data often do that. They often give you mixed signals. I think, however, that we do know that the trend of the labor force must have slowed down because we have independent estimates of slowed employment growth and our insured unemployment system, which essentially confirms the fact that the unemployment rate is also very low, so that the arithmetic of the system is confirming that there is a slowdown out there in the labor force. What we do not know is whether or not it is a temporary 6-month oddity, which we've seen many times in the past, or whether there's something more fundamental here. I don't think we will know that for a number of months, maybe not for a number of years. but that something has happened, that it is not all the result of the slowing down in economic growth, I think is clear. What its full implications are, we do not yet know.
I'd like to ask you just a last sort of generic question, if I may. There was a period in this country when Franklin Roosevelt talked about fear being the only thing that we had to fear, and I find in New England, speaking for New England, but I think for a lot of parts of this country right now, if you look at the polls, the most significant figure that pollsters are now focused on is the perception by Americans that they don't know what the future is going to be. They don't believe it's going to be as good for some reason. I think it's something of great concern when you measure what's happening in housing, in homelessness, in education, the functional literacy of 20% of our high school graduates and so forth, other problems in the workforce. I think people are feeling these things, and now the S&L crisis, the comments of Seidman and so forth. I'd just like to ask you, as this principal figure in the structure of our country on economic matters, if you might speak to that sense of fear for a moment and to the question people have, which I think is restraining economic activity and slowing us down to a degree. And I wonder if that is of concern to you. Do you perceive that? And if in any way you do, what is your prescription?
Well, Senator, what I think we do perceive is the fact that the economy, more importantly, productivity, has slowed its growth. This is not an issue of the last few years. It's really an issue which differentiates the early post-World War II period from, say, the last 20 years. And I think it is certainly the case that the slowed growth in living standards which we've experienced in this country has changed the level of optimism, if one could put it, that one sensed earlier in the post-World War II period. I mean, my working life sort of really starts right at the end of World War II and goes through it. So, I mean, I'm aware that there's a discontinuity out there somewhere 20 years ago. The 1980s, I think, have actually been something of an improvement from the 70s. I think there were increased senses of optimism, and I think they still carry over. I think that you're quite right, the S&L issue has created a problem, and I think that as far as the economic outlook is concerned, and I do think that the difficulty of getting our federal budget deficit down has been a problem. I think the trade issues have created some particular problems, but I think overall, we probably, I think we were in our worst stages, you want to put it that way, I would say in the latter part of the 70s. In other words, as when inflation was beginning to take hold and the degree of instability and concern about the future of the country really, I thought, got to very severe levels. We are still growing slower than I think we should be growing, and I do think, to come to the ultimate answer to your question, I think the bottom line to all of this is that we have got to get productivity increasing at a faster pace. The only way that I can see that occurring is through the investment and savings issue, which is the reason why I said earlier to one of your colleagues that I thought the highest domestic economic priority in this country is an increasing savings rate. I think that improving the rate of growth in the economy would change a number of the problems which you identify. I think, however, referring to my earlier statement, I think it's very easy to exaggerate the negatives. I think in many respects we underestimate a lot of the positives, but things are not as good as they could be. And I think it's fairly evident that were we able to pick up our growth rates in this particular period, I think the attitudes as you identify them, and I sense them, as everyone does, would change.
I thank you very much, Mr. Chairman. Thank you, Mr.
Thank you. I would just add to that. I want to ask you one more question, and we'll finish here. You've been very patient. My own mind, I think our overriding national goal has to be getting the productivity rate up. We're doing about 2% a year, just below that in recent years on the average. We need to get to about 4%, and you can actually lay out a pretty clear-cut set of strategy options that can take and increase the savings rate and the investment rate to beef up the productivity in those levels. But if we can do that, we can solve our other problems. If we don't get that done, I think our problems are going to increase. Let me take you to page 10 of your testimony, and this is the one item I want to finish with. On page 10, with respect to what you see happening out there in terms of the tightening of credit standards and what's going on in some form of a credit contraction, you made this statement. You say, nevertheless, in the here and now, the tightening is beginning to have very real, unwelcome effects. And then down about 6 lines, you say, in recent weeks, however, we may have slipped over that line in terms of the tightening down process of going beyond what would seem to be sound from the point of view of at least the monetary policy impact that you would like to see out there. Tell me what the data is. What are you hanging your hat on that is causing you to make that kind of I think, definitive statement here? Can you give us the data? I mean, I'd like you to summarize it, and then I want to know if it's something we can have so that we can take a look at it ourselves.
First of all, we see in the aggregative data a significant slowing down in the rate of growth in the various different credit aggregates from levels which we had always perceived in our analysis to be excessive relative to the needs of financing a certain level of nominal GNP. It's clear in the early stages, and in fact, I would say up until recently, that all of that was not only desirable, but very healthful to the financial system. And we began to see evidences of that as we, for example, looked at the balance sheets of the financial intermediaries and the income statements, maybe the depository intermediaries. What you could see at that particular point was a gradual contraction coming down. The question basically then arises, is there a point at which it becomes too restrictive? In other words, do you get to a point where essentially commercial banks particularly are beginning to pull back to a point where it looks as though the commitments that will be made will then start to flatten out to a significant extent, creating effectively a tightening in the credit markets? What we were looking for and did not see in any reasonable way, say in the spring, is the fact that margins were beginning to open up in banking, meaning that commercial banks were seeking to increase their margins because they were fearful of the threats to their capital or to the quality of their loan portfolios. We began to see very early stages of that which are not consequential. And it's only very recently when, in talking to, for example, a lot of bankers with respect to what their loan policies are and what is effectively happening to the spreads, that we're beginning to get indications, although no hard evidence, because the hard evidence won't occur for months. You won't see it for a while. But it is enough to see that it is credible, especially if you're getting the type of responses we are getting in, for example, the money supply data. The money supply data looked as though after it had dipped down in May and it started back up as though it was really going to move, and it has since slowed down again rather substantially. It is growing. It is growing at a relatively modest level. But it is indicative of the type of phenomenon that which would exist if we are slipping over the line. And while obviously I don't want to make too much of a specific line, there is enough in my judgment out there to suggest that we were increasing the pressures on the economy. And I must say that's one of the reasons why I think we have increased the probability of recession a shade, not much, and I think we probably have offset most of that in the action that we have taken.
Just last week, the action that you announced.
But I will tell you this, that when you get into these types, this type of information, it is very important to try to collect it from a wide variety of sources. And this is one of the reasons why I think the Federal Reserve has an exceptional real-time information processing system in which data feed in, and it comes in a variety of different forms. In other words, if you're waiting until you get the published number, with the rare exception of things which you publish on a weekly basis, you'll always be acting much too late. You'll always be looking at the last war. We have no alternative but to try to anticipate what we think is happening. And it's in that context that it began to appear when, for example, the money supply growth stalled out, that there was more here than we had originally appreciated. And in my judgment, had we done nothing, then I think we would have increased the probabilities of the credit system beginning to crush on the economy. I think, as best I can judge, that we have alleviated that pressure at this particular stage. And that's the reason why I remain hopeful that the economic growth that we're envisaging, which is not robust, but nonetheless there, will continue.
Now, is my memory correct that about, maybe 3 months ago, you and other bank regulators met with representatives of the largest banks of the country?
No, we met with representatives of the American Bankers Association, which is both large and small.
Let me make that correction. So representatives of a mixture of American banks. That session, as I understood it, was my word, jawboning session, or a session to try to talk to the bankers about not being too restrictive, to tighten down to a prudent point, but not overdo it. And that's the general characterization that came off that. It sounds to me like, if that is an accurate description of what happened, that in the time since, you still are not convinced that you were getting that effect that you might have wanted, and so you've now had to insert an element of monetary policy adjustment to deal with it.
Well, let me just rephrase the way you put it. What we were concerned about at that meeting at the ABA was that it not be perceived that the regulators and the examiners were basically suggesting to the bankers that they pull in their horns. In a sense, there is a related issue here. I mean, we basically were concerned that they would in fact do what apparently has happened in part, but it was not clear at that time that that was going to become general, and we surely hoped that it would not. And I must say to you, up until recent weeks, I had every reason to hope that we would avoid that sort of phenomenon, and that was just a temporary phenomenon in which we go through all the time. That did not turn out to be the case, but it's not something which you can know for sure or forecast with great definitiveness.
Well, I take it from what you said a moment ago that your data is still fragmentary. In other words, part of it is data that's coming in, part of it's your feel, part of it is anecdotal, I would assume.
Well, I hope it's not feel, because
Well,
feel is not very useful. I hope what we have are,
well, that's why I asked.
Real information. We don't just take summaries of banks or something. The question basically is that when you get certain types of evidence about what is going on in the lending and fee process within commercial banks, in the smaller banks, and the medium banks and syndications, certain things begin to evolve which look more than random. And it's when you can draw that conclusion, then you're reasonably sure that certain fundamental things are going on, even if you don't have the exact numbers to verify it.
Well, you said a moment ago, I understood you to be saying that the adjustment you made last week, the policy adjustment, was matched to what your data suggests to you is the size of the problem. I mean, I don't want to have it read back, but in essence,
the rough order of magnitude.
And so it sounds to me, is based on the data that you do have and the analysis that you have done, you have now made the policy adjustment. You feel you've made it. You're not in the middle of 6 or 8 different adjustments, and you've only made one of a large number that you anticipate anytime soon, that you, in effect, have moved in and you've tried to make the adjustment that fits the problem as you see it. Is that a fair?
Up to this date, I would say that is correct. But as I indicated to you in my prepared text, we think this process is still moving. Whether it moves enough to make any further material difference, I frankly don't know. I hope not.
Mm-hmm.
It may well not.
Mm-hmm.
And at this particular stage, I would say we are watching it very closely. The main thing I think we have to emphasize about this, and the reason why I hesitate to call this whole thing a credit crunch, we are dealing with relatively small types of changes. I think they're important enough to respond to. But if we had a real credit crunch of the types we used to have in the past, we are talking about a fundamentally different type of phenomenon.
Mm-hmm.
And the reason why I tend to be somewhat resistant to responding to the contraction of credit growth that has been going on is I perceive it as something healthy, something which will be advantageous to the long-term financial stability of our system. So I want to try to distinguish that, and because I think it is crucially important from a policy point to make that
Well, I agree with you, and I think you've made it clear today that this was fine-tuning. This was not a now you tell me if you don't agree. This was not a major policy adjustment. This was, you've said it several different ways, was a fine-tuning adjustment, and further you've said today that it was not designed to drive down interest rates. It was in a sense to hold interest rates
to hold credit conditions the same and in general to keep the markets stable. What that was not, that was an action which directly related to a specific credit problem that we perceived, and what we did is to offset. We were not looking to fundamentally change the underlying credit conditions in the economy, which is what policy would do if, for example, we were looking at a more profoundly important change in either economic activity or inflationary pressures. Because when we react to either of those, it's a major change in policy which tends to be progressive. And I must say to you, as we view this, we do not view that in that manner, as I've tried to convey.
Yeah, I'm going to just finish with this comment, and that is that if things change further, and that can happen, you obviously no one can read the future.
They can change in either direction.
Yes, I understand. But if we find that they do change in the next several weeks, next 2 or 3 months, and that another policy adjustment is needed, whether or not we've got an official hearing such as this scheduled, I will certainly, and I know the committee will want to meet again with you if we find that there's going to be any kind of a consequential policy adjustment in the, over that kind of a time frame. I'm not saying that anyone foresees that or you foresee it, but if things are changing further and beyond the scope of the discussion today that requires that kind of a further adjustment, I think that'd be something that we would want to at least have you illuminate for us.
Certainly.
Very good. We thank you very much. You've been very patient and very straightforward as always. The committee stands in recess.